I'm gonna do something here. Okay, the financial statements. There's four of them that are required. So when you're issuing the financial statements, my keyboard is falling off here. There are four statements that are required. First one is the income statement. The second one is a statement of retained earnings or statement of equity. Oops. Balance sheet. And the last one is the statement of cash flows. So these are required. All right. Now, these first three have been around for about 400 years. Oops. It's a very long time. But you can go back and you can see an income statement from 400 years ago. It doesn't look that different than what we have today. What came in, what went out. Statement of equity, sometimes it's included in the balance sheet way back when. It used to be included in the international standards for a while. But anyways, somewhere they're going to have a statement of equity, somewhere they're going to have a balance sheet. So they've been around for 400 years. The statement of cash flows is about 40 years old. Still a long time, but it's kind of the new one. And just to get, how new is it? When I started, going to college, it wasn't a required statement. There were companies that did them for their own, doing them on their own, but they were not a required statement. So the statement of cash flow is probably the least understood, but also maybe maybe the most important one. It tells about what happened to the cash. And when companies go bankrupt, they don't go bankrupt because of losses. They go bankrupt because they run out of cash. There are companies that for years have losses, but as long as they have cash, they can still go. Amazon was like that. Amazon had years and years and years of losses, but they were always able to have investors invest and get cash. So they were always able to carry on. And so the statement of cash flows is actually very important. And, some would consider it more important than, say, the income statement, even because it talks about the cash that comes in. There's a lot of people that don't like it. There's a lot of accountants that don't like it. I was at a seminar one time, and it was about the guy who was speaking. It was one I really wanted to go to because the guy was speaking, and he was an auditor for the AICPA that would audit other CPA firms. Maybe I'll put that. Let me write this out. Because it's called a peer review. It's not necessarily for this class, but if you guys are going into remember CPA firm, a peer review. Bah. Yeah. Peer review, one audit firm audits another audit firm. And you basically, they look through and they see how they did their audits. And if you remember the AICPA and you are practicing, you will have a peer review. Someone will come in and they'll look and they'll see, are you doing audits up to their standards? So anyway, so this guy was there and we were, and I wanted to hear the guy. And he says some kind of crazy stuff. But one of the things he said is, I always ding them if they are giving their clients the statement of cash flows. He said, it just confuses the clients. Immediately, a bunch of hands go up. It's a required statement. You have to give it to the client. No, no, no. There's no standard that says you have to confuse your clients. I always ding them. It was the weirdest thing. And this is a guy who does the audits for the ICPA, but he just hated the statement of cash flows. So anyway, it's the newest one. It's probably the least understood one, but it's also probably, very well could be the most important one. It tells what happens to cash. Okay, and there are a couple different ways to do it. I'm going to show you the uh, indirect method. There's a direct method and an indirect method. The direct method is actually preferred, but you have to kind of know the indirect method to do it. And you also have to include the indirect method if you do it. Okay, so statement of cash flow. So the method I'm going to show you right now is going to be the indirect method. Let me write that in somewhere here. They're actually very similar. It's a little bit different, but not bad. Okay, so how do we do it? And you guys may have already had this. We have three different categories. We have operating cash flows. We have investing cash flows. We'll make those green. That's a little too dark. Make them lighter green. Okay. A. And then we have financing cash flows. And why isn't that capitalized? Oh, well, anyway, I'll capitalize it later. I'll make that blue. How about? That's weird. I don't know why I did that. These are almost all cut and paste, so I must have cut and paste from the wrong one. All right, so operating cash flows. What we basically have to do is get everything into a cash basis. For example, if you sell, if you make a sale for cash, that's fine. It's already in cash, right? If you make a sale on account, that's not cash yet. So the statement of cash flows really focuses on the cash. How much cash are you getting? And another thing about the statement of cash flows is that virtually everything goes through cash. I think I told you the guys that, but virtually everything goes through cash. So oftentimes, like if there's a fraud or something like that, it shows up on from the statement of cash flows. Because if I make a fictitious sale, I say I make up a customer. Okay, we're doing bad this year. We need to bump the sales up, so I'll make up a fictitious customer and say that I made a sale to that customer. All right, so that'll help us make us profitable or whatever it is. There's not going to be any cash coming in because that's not a real customer. So the statement of cash flows will say, okay, where's the cash? The Enron fraud was found because the statement of cash flows, and it was so bad that the last year before they all went to jail, they didn't put out a statement of cash flows, which of course stopped the trading on their stock and all that kind of stuff. But because it was just completely obvious that it was fraud because the cash has to show up somewhere if you're having sales. All right. All right, so let's take a look at how this works. We start out with our net income. and that's where everything starts from. So, and the presumption is that the net income is cash, but we're going to have to make some adjustments for it. And the first one we make is for depreciation or amortization. Amortization is just for like intangibles, but depreciation. And depreciation is kind of a wacky one, just in general. Okay, let's say that you buy a car for $30,000 and you drive it off the lot. At that point, it becomes a used car, right? So maybe it's no longer worth 30,000. Maybe it's worth, well, let's say 27,000. Okay, so maybe $3,000. It's no longer new. It's now a used car. So let's say that it goes down by $3,000 when you drive it off the lot. Did you write a check for $3,000 for that decrease in value? When you drove it off the lot, was there any cash involved in that? You can put it in chat if you want. Anyone?
What was it again? So like you drive a car off the lot, what?
Yeah, so the first year you have a car, let's say that it drops in value by $3,000. Are you going to actually write a check for that $3,000 that your car is dropped in value?
No, just the depreciation, right?
Yeah, there's no cash involved in depreciation. Depreciation was one of those things that it really wasn't even you. It came about about I don't know, like 100 years ago or something like that. For actually for taxes, people were looking for expenses, but there is no cash. No one writes a check for depreciation. So if you have depreciation on your income statement, it's getting subtracted out to your net income, even though there is no cash for that being sent out. So we're going to add it back in to the income because that was not cash. It isn't. If you ever hear about paper losses, people say about paper losses, that's what it is. A depreciation is a paper loss. You didn't actually write a check for it. I had a three flat in Wicker Park, and when first year I had it, I had a loss for taxes of $11,000. Yes. Because it was worth like $4,500 to me or something. But anyway, those are all. I didn't write a check for any of that. It was just all depreciation, and there was no cash, even though it. So this depreciation thing, there's no cash. So we're going to add it back in because no one wrote a check out for this depreciation. Okay, so we have to add back in the depreciation. Uh, Two other ones that are kind of strange, and they're strange because of how we handle them. Gains and losses. Gains and losses are different than revenues and expenses in that these are usually for buying and selling long-term assets. So these are usually for the sales of long-term assets. You bought an asset and you're selling it. Um, hey, I should say non-current assets. So these happen on the sales of non-current assets. These are long-term things. Oops. Now, we're not saying that they didn't happen, but we're actually going to have that down here in investing. These are for the non-current assets are down here. So this is where we're going to move those gains and losses. Now, notice that the gains get subtracted and the losses get added. We make them disappear because these belong in a different section. These will show up in the investing section. of the statement of cash flows. Have you guys had this before? So we eliminate those out of our income statement. Okay. Now, the other two things that we look at are the current assets and the current liabilities. So pretty much everything for the operations is either the income statement, current assets, or current liabilities. There's a few exceptions here, which I'll talk about later. But so we have current assets, current liabilities. So these are all things that are going to happen within a year. Now, here's where it gets a little bit strange in that it isn't strange. If your assets go up, any asset, let's say inventory, if your inventory goes up, generally speaking, what's going to happen to your cash? So inventory goes up, so you must have bought some inventory. So what happens to your cash? So if the inventory goes up, what happens to your cash? Yep, it goes down. So if an asset increases, that means you must have bought it. That means your cash must be going down. And the opposite is true also. If an asset goes down, if inventory goes down, that means you must have sold inventory. Your cash goes up. So assets and cash go in the opposite direction. If an asset increases, the cash goes down. If an asset decreases, the cash goes up. Now, cash is an asset, but that's what we're trying to explain. And actually, if we do it here. You notice under current asset, it says except for cash. One of them is except for cash, and that's because cash is what we're going to be explaining, what happened to the cash. The plus and minuses of the cash, we're going to go through. That's the entire statement of cash flows, what happened to the cash. So you'll notice down here, though, for assets, if it increases, the cash goes down. If it decreases, the cash goes up. Liabilities are a little bit different. So liabilities are when you borrow money. Okay, so I need some money. I go to the bank, I borrow money from the bank, and maybe I get a loan or whatever it is. Is my cash going to go up or down if I get a loan from the bank? At least initially, if I get the loan.
It would go up, yeah, because you get more money.
Exactly. So if liabilities go up, your cash goes up. And vice versa. How do your liabilities go down? You must pay them. Excuse me. So when you pay your liabilities, they go down. So if a liability decreases, your cash decreases. Okay. So liabilities go in the same direction as cash. So it depends on what kind of account it is. If it's an asset, it goes in the opposite direction. If it's a liability, it goes in the same direction as cash. And we're going to do a problem here in a minute or two that kind of make it more accessible. Okay, investing activity. This is basically all your non-current assets and any other investments that you have. You might have investments that are short-term or not, or current. You'll also include those here. So all investments, whether they're current or non-current, go in here, and all non-current assets. So we're talking about investments, property, plant, and equipment, intangibles, other assets. Anything that's long-term will go in here, and we'll have a few of these other ones. For instance, up here, the current investments will also go in the investing section. And these aren't too difficult, quite honestly. If you sell them, you get money back, you get cash, your cash goes up. If you buy them, your cash goes down. So, and that is kind of intuitive. You buy an investment, your cash goes down. Yeah, you sell it, your cash goes up. Okay, the last section, financing section. But these two kind of go hand in hand, by the way, the investing and the financing. I'm going to make that all capitals. I am going to right the wrong of the financing section. Oops. All right. You don't have to do that. I'm just doing it because I'm neurotic. Okay, this is for all liabilities that require interest payments and the equity section. So this is kind of long-term stuff on the liability side. So short-term is here. This is usually the long-term stuff. The only thing is with the payables, it's the kind of dividing line between these two. If it's current, if it goes in with the operating, or if it goes in with the financing, is do you have to pay interest on it? If you have to pay interest on it, generally it's going to be a financing cash flow, and it'll go down here. If you don't pay interest, like a accounts payable, taxes payable, um, accrued items, accrued liabilities. I don't. Did we talk about that? I can't remember. Accrued liabilities are just like payables, but they're usually payables that are not on the books. For example, if you need to pay employees, you don't, the employees don't hand you a bill and you put it in the, put it as an accounts payable to an employee. You owe them, you generally put that in what they call accrued liabilities, and that is that you owe them, it's money that you owe them, it's accrued over a period of time, whatever it was, the last week, last month, whatever it is, and you need to pay them, but it's not a payable and that there's, no one handed you an invoice or anything like that. So that's what accrued ones, and those are generally short term. Virtually always they're going to be short term. When they say accrued liabilities, it's almost always short term, and usually and oftentimes very short term, like for payment of employees. Okay, what are we talking about? Okay, so down here, so anything that is a, if you pay interest on it, it's going to be in a financing, but also stock. So if you if you sell bonds or get a mortgage payable or a note payable, it's going to increase your cash. I think we talked about bonds. Maybe we didn't. Bonds are just bonds are the same thing as getting a loan. It's just you chop the loan up into a bunch of little parts so that you can get it from more people. Usually, the larger companies they need to get bonds. Smaller ones generally don't. You go to the bank. If you need to, if you need $3 million, you can go to the bank. A bank can float that $3 million loan. If you need $300 million, there are fewer banks that'll float that. So what oftentimes you do is you, instead of getting it all from one, you make it, you have these bonds and you sell the bonds. When they say selling the bonds, it's a little bit a misnomer because you're actually borrowing money from people. A bond is you borrowing money, and whatever's listed on the bond, that's how much you're borrowing from the person. So if it's a $10,000 bond, you sell it to them. What really is happening is you are getting a loan from them for $10,000 that you have to pay back. So when they say selling, selling or issuing or whatever, that really just means that you're actually borrowing more money. So they say sale or issuance of bonds. This is what they're talking about. Decreases, retirements mean that you must have spent money. So that's same as we did up here. You notice the current liabilities and these long-term liabilities are the same. They increase as those accounts increase, they decrease as you pay off your liabilities. All right. Same thing with stocks and bonds, or excuse me, stocks. I did bonds. Any increases, the more stock you sell to the outside, the more money, the more cash you have to work with. If you buy back stock, your cash goes down. And the one that is always true is cash dividends are always negative. Cash going out. A little bit of mopping up here is there's also a schedule of non-cash transactions if they don't have any, excuse me, if they have non-cash transactions. Oh, don't do that. There we go. There are transactions that may not involve cash. They're kind of unusual, but for instance, if they traded stock for land or stock dividends are when they don't send out cash, they send out more stock. There's no cash involved. So these are kind of it to explain to people if as to those transactions that didn't have any cash, they don't show up on the statement of cash flows. For instance, if you traded stock for land, someone may look at the statement of cash flows and say, "Wait a minute, we got this land. How come there's nothing in here about them purchasing land? Why is that?" And same time, maybe looking at the stock, look at the stock increase, but there's nothing in here about selling stock. Well, why, that sort of thing. So the non-cash is really there to just to explain that, look, these are the transactions that happened that there was no cash involved. They're fairly rare. Almost everything goes through the statement of cash flow, or excuse me, the cash account. But if they do happen, you have these schedule of non-cash transactions. All right, let's jump in and do one of these. It's probably the easiest way to do it. Okay. So cash flow statement number 1. I don't have that listed. I'll put it here. Oops. I'm sorry. Okay, I'm back. Okay, so this is so statement of cash flow 1. We'll do this one. Starting out with the operating cash flow. So for the Excel sheet, I put this over here. Kind of our, oops. Okay. So let's go down the list here. We start out with either net income or net loss. In this case, what did we have? We have a net income or net loss on this thing.
Net income.
Mm-hmm. keep me from doing it incorrectly, I'm going to use formulas here. So our income was well, 60. And we're going to make adjustments to that because there are things that happened in the operations that will change the cash there. Okay, depreciation expense. Now notice, here's the depreciation expense. We subtracted it out, but there wasn't any cash involved in that, right? I mean, we wrote off $345 worth of for depreciation. We didn't write a check for that at all. So there's no cash involved. So we're going to add that back in. So depreciation expense is always added back in. Oops. I know. New plan. So depreciation expense is going to be added back in 345. Okay. Gains and losses. Do we have any gains and losses?
We have a loss on the sale of the investment.
Good. The tricky part, what do we do with a loss?
We added back in.
Yep. Very good. So this will be added back in 45,000 or 45, I guess is 45. Okay, so let's see. So that takes care of these, I think. We don't have any gains, no gains. Okay. I'm gonna yellow the things that we've already done here. Okay, so let's go to the current assets. Now we're not going to do cash. Cash is what we're going to try to explain, so we're going to hold off on this one. But we still have other current assets. So accounts receivable. Did accounts receivable go up or down from 2026 to 2027? Be careful. This is 2026, so this is the earlier time. This is the current year. This is the previous year. So did accounts receivable go up or down?
It went
Up.
Up. Yep. Okay, so it went up by 50. I'm going to put that in right here. So let's say accounts receivable increased. Do I have enough room? Oh, I better put it up here. Yeah. Okay, accounts receivable increased. So tricky part. What happened to the cash? Did it go up or down?
We have to subtract it.
Good. Yep. And for accounts receivable, you can think about it this way. If it went up, that means that's cash that we didn't collect. There's some cash in this income, some sales in that income that we didn't collect. 1,050 of them, as a matter of fact, that we didn't collect in cash. Okay. Inventory went down. It was 5250 in 2026. It went down to dropped by 600. So inventory decreased. All right, so what happened to the cash? It's an asset. It went down.
It'll increase 600.
Yep. Yeah, we must have sold that, right? We must have sold more inventory. So it's kind of like opposite day when it comes to the assets of what happens to the cash. Any asset that goes up, cash goes down. Any asset that goes down, cash goes up. Okay, now so that takes care of these two. Got that. Got that. Current liabilities. We're going to have both those highlighted. For current liabilities, we only need the accounts payable. Okay, and that change went down. If I say something stupid, let me know. It went down though, right? 2026, it was 2850, and it went down to that. Okay. Did our cash go up or down?
Up.
Actually, it went down. The liabilities will go in the same direction. So if our accounts payable went down, we must have paid them. It's as strange as it sounds, like if you don't pay your bills, your cash goes up because you're not paying your bills. But anyways, this we must have paid them off. So our cash is actually going to go down. So this will be accounts payable. I should label these. Hmm. Maybe I should spell them right. How about that? So accounts payable decrease. So again, so this is a liability. So this one it'll go in the same direction as cash. How do liabilities go down? You pay them with cash. So the difference between um, these are assets. It's a liability. So if assets go in the opposite direction, liabilities go in the same. So this will be our investing. I said that wrong. This will be our operating cash flows. They usually say net operating cash flows. Yeah, okay. So let's make that. I think I already made something green, didn't I? I already made we'll say, yeah, I'll make it green. Okay, so I'm gonna add all these up. Hopefully this one. To zoom stuff all over my screen. 675. You guys may want to do that. uh, check that. I need my calculator just to. And by the way, if you're a little confused with these, many people are, and even companies. General Motors um, had an error.
Professor,
Yeah,
I had a question. So you start with the 1260, right?
yeah,
And then you subtract the 345.
had it.
You add it.
Yeah, that's the yeah, depreciation is always added, which is kind of strange, but yeah, it's always added because there's no cash involved. So depreciation expense is always added back in, and amortization, which is the same thing, but for yeah. And if you look over here, so for instance, over here when they got their net income, this 1260, they had subtracted out this depreciation expense, but there wasn't any cash. There's no cash in here. This is a no cash transaction or non-transaction. I think that's right. Yeah, so this the depreciation expense, yeah, it always gets added back in. The way we do depreciation expense, and by the way, it's not just, it's not just the United States, it's, other countries do it too. Um, that's one of those things that when economists look at it, they slap their foreheads. Like, what are you doing, man? That's not a real thing. Um, and again, literally when they started taxing people, income tax like at the early 1900s was a brand new thing. Um, they always had like tariffs and things like that to raise money, but income tax was a completely different thing. And so when they did that, then everyone starts looking around for expenses, and this depreciation came about because of that. It still sticks around, but it's not really. If you look at it, if you're in an econ class, that's not how they classify depreciation. Actually, I'll tell you how you can do it. Find out what the real depreciation is. It's not going to be in this problem, but I'll show you where to show up in a problem in a statement of cash flows problem. Yeah, so this is what the operating cash flows, and quite honestly, this is often looked upon as the most important number of all the financial statements. How much do they get from their operations? Down here is the investing stuff, down here is borrowing stuff, but from their operations, for instance, Coca-Cola. How much did Coca-Cola actually make in cash from their operations? Regardless of what their investments and how they raised money and all that. Question on that? Okay. Well, let's go to investing cash flows. Now, these are generally the long-term assets. So we have non-current investments, and we have fixed assets. Okay, I'm going to go down the page here because these two I happen to know are down here, and they are a little bit more better explained down here, let's say. But we'll talk about how they came about. So additional information. Non-current investments were sold for 405,000. No, 405, just 405. These are in the thousands, are they? It doesn't say. Okay. So 405. Let's take that one first. So non-current investments, even if these were current investments, we would still put them in this investing section. But these were non-current ones. We sold them for 405. How much was the change in that account? The change in that account was 450. So they sold investments that they had paid 450. So why, so they sold it for 405. Why they're not the same? What part of the puzzle am I missing? I'll give you a hint. I already covered it, or we already covered it. Why didn't we get 450? We sold them for 405.
Was it because of the loss of on the sale?
Yep,
$45 there,
yep,
yeah.
yep. Wait, it's right there. Yep. So this is it. So this lost 45. This is exactly what they're talking about. So we sold 450 worth of the investments, and we only got 405. So we had that loss of 45. So we take it out. So notice that even though we had this loss, we still had cash inflows of from $405. So we lost money. It's true. We wanted to sell them for more, but we did. But we had investing cash inflows. We did have cash come in. So this is sold investments for 405. And you'll notice that in some ways the the gains and losses when you come here they get neutralized up here. Scratch that. They get neutralized here, and they really don't matter. If you're just looking at cash, what cash really happened was that we got $405. Losses or whatever doesn't really matter too much because it's okay. Fixed assets were purchased for $3,000. Okay, so if we purchase fixed assets are things like property and equipment, usually property, plant, and equipment. Uh, so we bought those for 3,000. They're long-term assets, so they're non-current ones, I should say, non-current assets. Is our cash going to go up or down because of that?
Gonna go down.
Yep. I'm going to change this. I just realized I did this wrong. We're marking these all in that color. Okay. So purchase fixed assets, 3,000. Yeah, those aren't formatting. The computer I'm using is somewhat new. And it's doing things that my old one didn't. I just have to get it sorted out. But I had one that that I worked with for years, and yeah, it's actually sitting right next to me, but And sometimes I still use it. Wait, how do I do this? Where's the old computer? Where's my supper dish? I think that's it for those. I don't think we had anything else for long term. Oh, here's something kind of crazy though. How come went from 9,000? How come it didn't go to, we just bought 3,000 more? Why didn't it go to 12,000? I'll give you a hint. It's a very important little word there. Oops. Look how big it is now. It's not a little word. Did that change like that? What does net mean? Net of what? What do we subtract out of?
Would it be the net cash flow?
It'll be in there. It actually will be it'll be the depreciation expense. You know, actually the 3,000 did get added. It did go up to 12,000, but then they depreciated 345. Which truthfully, I mean, that, you know, as a side note, there's no cash for that, but that's how they get that. So that's plus 3,000 minus the depreciation. I don't know why, you know, that depreciation is one of those strange things that is just, you know, we've done so many things with like the market values and all this kind of stuff, but that one is just stubbornly not going away. It probably won't. Oh, I know what I was going to tell you. It didn't happen in this one, but I'll tell you that on a normal investing cash flow for like a publicly traded company, um, that they will have a line item usually on here somewhere for the investing cash flows for capital investments. And usually these are when they just have it listed separately, this is for uh, assets that they already have. Color make it. But if you look under capital investments, this is actually the true depreciation for a company. And if you're in your finance classes and you're wondering why why are they putting in this capital investments from the statement of cash flows into the income statement? You know, why is that? This is actually what they would call the true depreciation. I can tell you one of the reasons why they don't like, probably why they don't like putting this in the income statement, and that is that you can manipulate it. You know, don't make as much investments in that, and that they might have the feeling that it would be a negative thing for the businesses. It would cause them to not keep the assets up to date and to make themselves look more profitable. But anyway, so if you look under capital investments, or something called capital expenditures. And again, when you're in your finance class, when they do the when they try to figure out what the true income is, they'll oftentimes take out the one that is in there, the depreciation. You know, add in the depreciation expense, and then they'll subtract out those capital expenditures, which is pretty close to the true depreciation that an economist. That's what an economist would look at and say that's the depreciation right there. All right. Let's see. Let's go to financing. Okay, financing. Bonds payable. We do have bonds payable. There's nothing else given on the bonds payable. All right, so bonds payable, let's look at those. Those changed. They went, hey, look at that. You can just drag it down there. Did bonds payable increase or decrease?
Increase.
Increase.
It increased. So what will happen to our cash? Here's bonds payable. It increased. Our cash will go.
Will that also go up?
It'll
Yep.
go up.
Yep, exactly. I don't have this written up here anyways. Okay, so bonds payable increased. And you may be saying to yourself, well, wait a minute, they have to pay that off. And when they do pay it off, it'll go down. But when they initially get it, it'll be that it increased. And there's one that I always forget. For the financing. So the financing section, there's one that I always forget, and you have it here. It's this one. Dividends paid. If you ever do a statement of cash flows and you don't see it's not balancing, we'll show you how you find that out. It's most likely cash dividends paid, or often I should say it is for me, anyways. Oh, I didn't total these up, did I? You're just supposed to yell at me when I do stupid things. I didn't add up the investing cash flows. All right, so that's our net investing cash flows. They're net financing cash flows. And we need I'm sorry, as our investing, we need our net financing cash flows. I don't think there's anything else there. Stock is the same. It's only stock. Retained earnings. Retained earnings change because of income and dividends. And we've already got both those in here. Here's the income. Here's the dividends. So this is actually already taken care of. So you don't do anything with retained earnings. Only the stock and bonds that are issued. And after all that talking, we're still not doing it. Okay, so net financing. Excuse me. And by the way, you'll often see that these investing cash flows and these financing cash flows, they kind of go together. Investing cash flows, at least in a healthy company, those will be negative. They'll be investing in things. And down here, this is the long-term stuff. This is how do you find that money to invest it? So the financing section usually funds this growth of the big stuff, in the investing section. So usually if a company's growing, it'll look like this. Investing cash flows will be negative and financing cash flows will be positive. And it does sound kind of strange, do you want a negative? And For the investing section, yeah, you want to see a negative. Why? Because a company that is growing. If it's positive, that means they're selling stuff off. They're shrinking. And they may have good reasons for doing it, but generally speaking, you want a company, growth is what they talk about. And so as odd as it sounds, for the investing section, you want that to be negative in general, because that shows that they're actually investing in it. All right. So let's see, are we done with that? Okay, so here's how this all works out. We're going to take each one of these. I'm going to bring them down here. Just you don't have to do it this way, but I'm going to just do them separately up here. That's fine too. I'm going to begin them all in the same spot though. And all these together, these will be the net cash flows. How should we do that? Okay. So here's our net cash flows. Now, coming up here, that should be all of our change for the cash account. And it is. So we have 450 plus our beginning cash of 2,700. I'm going to make these a color so we can. I use that one yet? I don't think I use this one yet. Oh, probably because I can't see it. That's probably why I didn't use that one yet. Let's lighten it up a little bit. Okay, so what this will explain is this is how our cash went from, oops, I'm going to add these up, from 27 to 3150. The change was 450. We explained this change in our cash. So this 450, this change is explained by the statement of cash flows. How did it change? Our operations, we got 675 in cash. Our investing section, we paid out 25.95, and financing, we came up with 2370. That's how we got our change in cash. All right, we're a little late. Let's go ahead and take a break, and we'll come back and we'll do the second one together. Actually, if you want to get started on it, you can actually do that. But when we come back, I'll go over that one too. So let's see. So let's say be back at 316. We're gonna move this out. Okay, I'm just gonna show you the I haven't looked at this yet, but this is the annual report for Ford 2023. And about halfway down, you find the financial statements. Ooh, here we go. So this is Ford. That doesn't look like what we're looking for. Say selected. Okay. And usually about halfway down, this is a 214 page report. We're at 108. About halfway down, you usually find the financial statements. Oh, here's the auditors audit report. Rice Coopers did their audit. Didn't know that. Okay, anyway, so let's take a look here. We get a statement of cash flows. Capital spending. Remember I told you about the depreciation, what's the real depreciation? This is what usually they would count as, this is what economists would look at as the real depreciation, the capital spending. So if you're wondering what the real or what is closest to, let's say, the actual depreciation, it's that. I wonder if there's a list of that shows there. It's kind of interesting. They put their statement of cash flows first. You know, probably the accountants want to, or the analysts want it that way, I imagine. They don't break it out separately. You have to go digging for the depreciation. Actually, no, you don't. Should be up here. Okay, so here's their depreciation that they, oops. So here's the depreciation that Ford actually put on their books, 7690. This is what the economists would probably look at and say, this is the actual depreciation, 8236. Those are pretty close. Yeah. What's five or 600? What's 5 or 600 million between friends, right? I mean, but yeah, so that's what they would. If you're wondering about this Santa Cat, I had no idea that they had it first. I mean, that it makes sense because it's like I say, a lot of analysts, that's what they'll be looking at first is a statement of cash flows. Okay. Hey, where's Waldo? There he is. Okay, let's go to. I'm on the wrong thing. Sorry about this. Old confused guy is working my computer. Okay, let's go. This is very similar to what we just did. You know, it's just to kind of get you guys, you know, I don't know how much you guys have done in your other, you know, if you guys have seen it. Hey, have you guys seen this before? The statement of cash flows? I don't know if they cover that in other classes. They go over it or no? They do. Okay. Yay. Well, good. Then it's not so unusual. But anyway, so go ahead and do this one. And again, this is pretty much same as we've been doing. You're kidding. There's same numbers on the PDFs.
No, I think they're a little different.
Well, I want to make sure I did it. No, they're not. They're the same. Shoot. That is my big mistake. You're kidding me. Ah, uh, this is gonna sound really bad, but I got to go back to my old computer to convert those. They're similar on the Excel, but I'm looking at the uh, at both the document and they're the same. Let me. Give me 1 second. I'll send those out. Stop sharing for a second here. Actually, I don't have to stop sharing for a second here. Unshare. I realize that I'll have them in my email over here. Hmm. once, like 3 minutes, I should be able to. Okay, no, you might have to stop sharing. Okay, hopefully if you get those momentarily. Um, and I will update those online. Okay, my apologies. They're updated in Blackboard and I sent out an email. I apologize. Not exactly sure how I did that. I shouldn't say that. It's not surprising that I goofed it up. All right. Well, I was doing to start playing this in. Have you guys got it yet? No. I did put it.
Yes, I got it.
Oh, okay. I did put it in Blackboard, so it should be in there. I apologize. this term, I've been teaching, I taught this class so many times and that, I taught it once other here, but I've also taught it like dozens of times at other schools. I just wanted to get new material. Sometimes you do the same thing over and over again, and you get to where you don't even know what you're. So anyway, I've been redoing them so that hopefully they're better, but you guys are unfortunately the guinea pigs for this. And I apologize for that. Where's Waldo's making a mess out of this? Let's see. Yeah, I think it's right. Yeah. I think it changed them in 600. Oh, I know. This is looking funny. So beginning cash was plus 600, which should equal the ending cash, which I think it does. Yep. There's a better way to put this all on one screen. I guess I could go across. I should. Maybe in the future, that's what I'll do. Start having this stuff. I'll start breaking it up to go across the screen rather than down. All right, so here's I think this is what you should have for your operating and investing cash flows. I'm looking it over again to make sure I didn't do anything stupid. And again, make sure the ones that kind of go against our grain are these two. The expense gets added in and the loss gets added in. And then just those terms in general, as an accountant, usually you go, oh, those are negative, but on the statement of cash flows, those are positive. Let's see, let's go down to. And so this is the financing cash flow, and then these are all of them together. Oops. Any question on that? I shouldn't ask that. Yeah, I got a question on that. Why are you constantly doing stupid things? I just turned off the old computer. It got a lot quieter in here. The old computer we had was when COVID hit. You probably remember you couldn't buy a computer and they're all sold out everywhere. So anyway, my kid had an old gaming computer. Yeah, he had a couple of them. So we never had any need for a gaming computer, for the stuff I do. So anyway, so we took the two old gaming computers. Both of our sons, they had gaming computers. So these were the oldies. They were actually worked very well. They got pretty decent video cards in them, so they actually were pretty. But anyway, they sound like a vacuum cleaner going off, when they turn because they got those big fans in them and all that. Even though they're outdated, back in the day they had, what? Okay, any question on this? Okay, I think if you want to, I sent out the problems. Just probably check and make sure these are done correct. Uh, 4.8. We'll go over this one. This one has it's not hard. It's just got a bunch of quirky things in it, which is why I kind of want to do it because it's the quirky things that the CPA exam will ask, for. So this one's kind of quirky, but problem 8.9, this is a cash flow problem. So if you wanted to give that a shot, I'll put that on as homework and give it a look and see if you can figure. And we're going to go over it next class, but it's actually a little bit shorter than what we did. Looking to see if there's anything crazy in here. The depreciation expense broken out at the bottom here. Blah, blah, blah. Here's your net income. They have two, these are both liabilities here. Oops. This is the only asset that they have, the only current asset they have. So they have two. They have two current liabilities and one current asset. Give it a shot. Give this one a shot. See if you can figure it out. The statement of cash flows, obviously if you take CPA exam, you're gonna see it in some form. I mean, they could be that they have a bunch of multiple choice questions on it. They could have a more in-depth, and they could, or they, of simulation, or they could have both, and multiple choice. But they definitely are going to test it. It's one of those things that's 100% going to get tested, just like all the financial statements. So you're going to find something on all of them in there. And the statement of cash flows is a really big one. Any questions? Okay, so see if you can give problem 4-9 You sure I got that right? I got these mislabeled. Man, I'm stupid. This should be 4-9. You're the right.
Professor, what? Sorry.
Go ahead.
What's sheet 3-4 in the cash flow that we were just doing?
Let's see.
In the Excel file, there's like the info, cash flow 1, 2, and then sheet 3.
I think this is, if I remember correctly, this is what we used to print out for people doing it by hand. Let me take a look here. Yeah, that would be what they could print out if they wanted to do it. But I think I used to just send out the Excel file, and then that would be, if someone wanted to just print that out, they could do that. I think I can't remember. I can't remember what that's there for, but it's just basically a sheet for writing it by hand. Yeah,
Thank you.
no problem. Yeah,
So nothing needs to be done though, like when we submit this activity on that page.
no, just these two. And,
Okay.
and again, I apologize for that. I'm getting goofed. Oh, well, actually, and for this other one, this should say 4-9 for homework. And again, take a look at it, and don't be afraid to make mistakes on it. It's the best way to learn. And I know I've told you this before, but like Nicky Lauda he was a very famous race car driver. He also owns Lauda Airlines. Anyway, he's got a saying that you learn absolutely nothing from success, and it's kind of true. You're successful, you go, oh, okay, and you can be bobbling along, but if you fail at something, you never forget it. So I encourage you to give it a shot, and don't be afraid of failing, because that's something you'll remember much longer than any of the successes. And we're going to go over it, so don't think like you're going to lose points or anything like that. We'll go over it and talk about it. All right, any questions? Okay, apologies. I'll do better next week, and I'll see you guys then.
Thank you, Professor.
You guys see it.
Thank you, Professor.